Thank you all for joining us. While they gave me the most boring talk topic, I promise it will be very interesting because we've had a chat in the back and thought that we're going to drop some alpha for you guys today. So what I thought we might do is do a quick round of introductions in case you guys don't know anyone here. I'll start with me quickly. So I run treasury and commercial at Infinex. We are a non-custodial wallet. The premise is very simple. We're trying to bring new users on chain. We're doing that in a non-custodial way. So no gas, abstracted private keys, abstracted public keys, make it very, very easy to use. Over to you.
Yeah, thanks. So I lead the EMEA region for LayerZero. LayerZero is the leading interoperability provider. So basically laying the rails for global liquidity and chain abstraction, connecting more than 150 blockchains across EVM, non-EVM ecosystems, and working with most of the prime asset issuers to help them move their assets seamlessly to any other chain.
Hi everyone, my name is Sergej Kunz. I am co-founder of OneInch. I and my co-founder introduced 2019 the first DEX aggregator. What is nowadays more than DEX aggregator, we are building different other protocols, intent-based swap protocols, cross-chain swap protocols by using atomic and non-custody approaches, and launched recently also a shared liquidity layer to empower DEX builders to build highly efficient DEXs and compete not on TVL level, but on the efficiency of the algorithms.
My name is Vadim. I'm the founder and CIO of Edge Capital. We run a market-neutral fund. We also run both on-chain. I think we're one of the largest players in the DeFi space. We do a lot of TVL deals, liquidity provisions, arbitrage, algo trading. Run more than $500 million in assets. Have been for 5 years. The team is almost 50 people, so pleasure to be here.
Hey everyone, I'm Armaan. I'm leading BD and growth for Turtle in the MENA region. We're a liquidity distribution protocol, which means we sit at the intersection between LPs and DeFi protocols. We effectively match capital between the two of them in curated opportunities and on-chain strategies. And in return, we also provide sort of protocols with a transparent and data-driven approach to track all of that. Good to be here.
Fantastic, excellent. So why don't we get straight into it? We often talk about liquidity in the sense of new dollars coming into the system. One of the things that we have been talking about is users. How do we bring new users on chain? How do we think about users as to giving them what they actually want? Maybe we could start with Ivar. What do your users want? What are you seeing from the front lines of the products that you're building? And what are the users giving you feedback on what they actually want to use?
Yeah, so maybe let's unpack that in terms of users as the builders, because they build on the LayerZero protocol, right? So I think first thing that comes to mind is that they look for security and battle-tested technology. So I think that's now pretty much solved. And then they look for configurations, composability that they can seamlessly expand to many chains. Chain coverage is another element that they're looking for, especially beyond the EVM ecosystem. So we're integrating with many non-EVMs, so Solana, Ton, Starknet, Stellar, and so you see more and more of that ambition to be present everywhere. If we take it one step further, maybe to the end users, what we hear is much more about the simplicity, right? Especially new users coming into crypto. I think sometimes if you're in the space for long enough, you think that stuff has already been improved from a UX perspective, but try to explain some of these activities to your family or friends outside of the sector. There's still a lot of better UX and simplicity and chain abstraction required. So I think that's the main priority there.
Yeah, good luck trying to explain to your grandma that doesn't know about crypto what a bridge is.
Yeah, or a vault, and that you first need to bridge your assets to the chain where the vault is, so you can deposit and then get a receipt token and take it back to wherever you want to yield farm. And that's difficult. I mean, if you're in the space, you understand it, but to get the next billion users on chain, it needs to be simplified.
Yeah. Sergej, you built a piece of infrastructure that pretty much everyone in crypto recognizes and uses. What's the next step? You've ticked the box of aggregating liquidity across multiple layer ones, layer twos, whatever you need. At what stage do you hit a different kind of user base? What stage do you hit a different liquidity base?
So we started 2019 by solving our own problem. So it was a pain to find the best execution price among all the DEXs we had back into the days. And we just built something on a hackathon. It was not even a proper project, but we recognized people start using it because it was useful. It solved our problem, and solved also the problem of the users. And nowadays we are also trying to solve our own problems first. A good example is last year we launched cross-chain swaps, fully atomic cross-chain swaps. It solves also the pain of other users who are using bridges and stuck somewhere in between, or using aggregators who aggregate. It's like building a scooter in the parents' garage with different technologies, with different parts from different models. Then you get something, you get a Frankenstein, where you have a price impact when you swap to the bridge, and then in the bridge you get stuck, and potentially after the bridge, after you did a manual transaction, you exchange to something what you wanted actually, but then you face a price impact because a lot of time passed already. So that's why we try to solve these problems by technology and keep proper standards. For example, everything what we build is non-custody, self-custody, and it's atomic. It's very important. No one should trust anyone in DeFi space. That they get what they expect by just trust. Back to your question about what user wants, depends what users. Yeah, from our point of view, users don't really care about safety when they use DeFi services. They are services who promise you to give an asset on the destination chain, on the other chain, and they give it very fast, but then you have to trust them. It's not about security at all, or safety of the user. It's not self-custody, it's dealer broker service, without a license. So it's custody service. So people don't really think about, safety, it needs to be safe for me, but they want just opportunity to make money. If they would be able to trade all these shitcoins, meme coins on centralized exchanges, they would do it without using any DeFi services from our point of view. They are in DeFi because they get early access to these meme coins, shitcoins, Trump coins, and whatever. So they can go early, and then later, when it's listed on centralized exchange, sell it and make profit. So they're looking for profit opportunities, and very often I see that they don't really care about what technology is under the hood. Is it semi-centralized service where settlement is done by the team itself, like a dealer broker? Or it's a fully decentralized setup where a lot of many market makers compete with each other to settle independently, and who is first, they take first. So they don't really care. And they go to more centralized services than 1inch right now because they get a little bit better execution because the team decide to settle by themselves and not cut the corner by using decentralized technology.
Yeah, it makes all the sense in the world that money trumps everything else. If you've got the ability to make a profit, you don't care who the counterparty is. You don't care whether you risk using a protocol that you've never heard of. Vadim, I'd be interested to know, you run a $600 million, something like that. Do you provide liquidity for some of these shit coins? Do you do cross-chain swaps for some of these? How do you manage that profile? How do you avoid getting burned?
All the time, joking obviously, we don't. so we pretty much focus on A, liquid assets, B, the one that we understand, C, that have relatively low volatility, right? So we're not gambling here, right? Depends what your strategy is. Some people do, good luck with this, right? So I think answering your question about how we bring more people in, there are 3 layers, right? One is credit, right? Think about it. You have 2 trillion of Bitcoin sitting, making no yield, right? So credit business is booming. A lot of people coming in. It's about $150 billion in assets between Avi, Maple Finance, and a bunch of other guys, and more from. So this is all working, right? So you have to borrow against Bitcoin, do something with this because you don't want to sell it. That will exist and it will grow because it's still small. The second block is payments, right? So payments are working as well, right? So more people coming in. Now you'll be tokenizing assets. You'll be able to transfer, Netflix stock from Schwab account to your Revolut account in Europe. Currently, you cannot do this, right? If you ever try to move money from the assets and from the US to Europe, good luck. Impossible, right? So you have to sell it, move money, buy it back, pay taxes, right? So the third block, that's where we are, right? So we're managing money in a market neutral fashion. So our goal is to make stable yield, nothing crazy, like 10 to 20% a year on a net basis, right? This element is working really, really well in crypto, and it has alpha that does not exist in TradFi, right? For example, basis trades, right? Arbitrage, leverage, things like this in TradFi have been gone already for 20 years, right? We still have it. Last block, things like yield farming, right? So I know there is a lot of pump and dump going in yield farming, but good projects actually do have alpha. Think about it. If you were deploying capital to Aave, Azerfi, take other projects like Athena, right? Hyperliquid, you made money because there was a lot of successful projects that gave up a lot of equity to early stage adopters, right? Does not exist in TradFi, right? It's more like a seed capital model. So there is natural alpha because there is equity dilution. So that's how we bring capital in. That's what we do, right? So and we actually see more people going into initially market neutral funds like us, right? So clearly, retail guys trade like with you guys, bunch of small tokens, everything else, but their goal is to make like 10x a day, right? My goal is to make 10% a year or 20% a year, right? So completely different profile, right? So there is alpha in it, extreme volatility, simply because 9 out of 10 tokens will not exist in 10 years.
Exactly,
right?
yeah. Just to follow up on that, so you've been doing this for 5 years, right? And the majority of the people here have been around for a very long time. Do you find it easier now, or is it harder because there's more noise, there's segregated liquidity, everything is separated, you don't know what narrative is coming next?
So in terms of the yield, it's clearly more difficult, right? Because previously it was very easy. Crazy basis yields, you arbitrage FTX and Binance, make 50% a year. A grandma could do this. We were doing it manually, like had 2 screens, and I were clicking like this, accumulating the positions. Now it's all bots automated, obviously more efficient, right? More competition. At the same time, there is much more interest from institutional players right now. You have proper custody, right? They didn't exist before. Now you have external custodial agreements with exchanges. Now you have clean solutions. You have ETFs in the US. Now you have proper basis trading, right? Now you have regulatory aspects. Now you have fund administrators, auditors looking at this. 5 years ago, it was a Wild West, right?
Yeah.
Easy to make money, but much easier to lose as well.
Right.
So I feel much more confident now than I was 5 years ago.
And Sergej, when you look at the flows, you guys have effectively God view. You can see where liquidity comes in. You can see where everyone is trying to get access to, what people are paying large slippage, large margin for to try and get in on. Everyone knows about Trump. That was probably an anomaly. Where do you see the users hunting for liquidity at the moment? Like where are they trying to get access to that is providing them with friction?
Yeah, again, question here, what users? So
Yeah.
just speak about people like him with huge pockets and a professional farming experience. So they're going to those chains and networks what provide incentives. They, like we have seen Linea, huge pump in liquidity because of incentives. We had seen huge growth of TVL on Unichain, and because of the incentives, after the incentives were finished, we see now really small amount of TVL on Unichain. So it feels like it's dead. Yeah, similar to Bearer Chain and some other. So these kind of users, of course, like trying to get more yield. Yeah?
What you're trying to say is value extractive. It's okay, we can say it. We're in a safe space here.
So how healthy it is, I think I'm not sure that it's healthy for these networks and projects to attract such big players to just only for small period of time to provide liquidity. There are other users who just hunting for opportunities to buy a shitcoin or meme coin at the beginning, or even to farm the points or to farm the kind of farming opportunities. And to get access and then to sell it. We have other users who are more professional. They are just trading WBTC, for example, CBBTC, and stablecoins. Ethereum, the major pairs right now on our 1inch protocol for swaps is Ethereum USDC, Ethereum USDT, Bitcoin, to the same pairs. Sometimes blue chips like Aave, Chainlink, Unim. But it's really the major thing, and like these hypes, they come and they go. Yeah, with the meme coin appears, a lot of volume, and then it disappears.
Yeah, right.
Also, the liquidity disappears. That's what we see. Yeah.
It's because Vadim has taken it all into a different pair. That's what's happened.
Maybe I can add to that as well,
Yeah,
right?
go.
Because we have a pretty good vantage point considering we maybe provisioned about $5.5 billion of liquidity on-chain into various different strategies, right? So we see a lot of that liquidity converging around sort of two dimensions, which is strategy and venue. On strategy, we're seeing the primary flows being around structured carry, right? So basis trades, ETH staking with options overlays, and the likes of strategies as such, basically. And on venue, we're seeing all of this concentrate around a few L2s, execution hubs, and a few performant L1s, right? LayerZero and 1inch obviously make routing to long tail chains possible, but the reality is size is moving between a few hubs, the execution hubs and the performant L1s. And that's kind of a good thing as well, because it improves depth and execution as well, which is what users want at the end of the day.
Yeah, and so Turtle does a really good job on finding out the best yielding opportunities, and then you funnel liquidity into that. When we talk about customers, you have quite a different user base, people that are effectively hunting for yield opportunities rather than trading and finding liquidity. Do you still see a big appetite for that now that points campaigns are less in favor? I don't want to say dead, I want to say not as good.
Yeah, that's a great question. To be honest, the signal for us in terms of how sticky flows are is how long they stay after incentives taper off.
Right.
And that's kind of what we have a pretty good view on, because we're managing all these different liquidity campaigns. And we're also giving our partner protocols sort of a transparent and data-driven way to track it, right? So we want to see how strongly the liquidity stays once these incentives are tapered off. That's what we're looking at primarily for sticky retention.
I would like to add to the users, to bring users on-chain. We face the chicken egg problem. If you have liquidity provider who are sitting in liquidity pools and actually losing funds, around 50% of these liquidity providers losing funds, because the liquidity is to 83 to 95% on all DEXs right now sits idle. It's also very interesting. I don't understand why no one is speaking about that, because like people bring billions of US dollars in liquidity protocols, but just imagine 83 to 95% of liquidity actually doesn't work. For swaps, it's just participating in the price formation, but it doesn't work even in curve. Even in the curve, you have on the both sides, you have a lot of liquidity sitting. If you visualize it in a proper chart form, you will see that actually the price is moving a little bit in the middle, and left and right, nothing happens. We need to improve this first to get more people, because we will have global liquidity hub, the biggest global liquidity hub, what will unite the whole liquidity, instead of, as compared to the centralized exchanges, you have like every centralized exchange is isolated environment. We have market makers who provide liquidity, and they need to pay market makers. Market makers do fake volumes as well to generate.
Why is there looking at me?
I don't look into you. I just look to the camera. So then we will solve really the huge problem here to how to onboard more easily the users, because they will come anyway, because we will have the biggest liquidity in the space.
Is that
maybe just to back it up with with the metric that we're tracking? Like, one of the things that we look at is how much dollar value moves cross-chain on a monthly basis, and that is growing massively. Obviously, through the product market fit of stablecoins,
and because it's easier now.
And because it's easier and because it's secure, as mentioned before. But I think around 4 or 5 months ago, it was 5 billion. And mind you, like LayerZero does around 90% of the dollar value that moves cross-chain. So it's very dominant in that space. 4 or 5 months ago, it used to be 5 billion on a monthly basis. Last month, it was 35 billion. So that is
Okay.
actually, growing
Why?
pretty rapidly.
Why and where is it going?
It is new chain launches that attracting new users, maybe for a short period of time. Obviously, looking for their own activity and product market fit.
So Vadim needs a new yacht. Is that what you're saying?
Yeah, he needs it there.
Just getting some spare cash out.
Yeah, but I think Plasma was a good example, right? So the 8 billion was moved into Plasma 10 days after launch,
Yep.
all through LayerZero. So that's part of what's driving that. But I think broader is the product market fit of stablecoins and more use cases being built there. Like payments, even lending use cases. So that's where a lot of this is coming from. And then I would argue on-chain asset management. So an explosion of vaults and an explosion of yield strategies, where it becomes easier and easier also to deposit into those vaults, like omni-chain, and just like have a better user experience.
And so maybe a question to all of you. You go.
Can I give 3 comments maybe to clarify a couple of things to everyone? Number one is on LP deals, like with you guys, we did a number of them, right? We run a joint vote with you, right? So first step, we want to see a real product that's actually working, right? If it's not working, of course we'll pull liquidity out, right?
Yeah.
Basis trading is working, to be honest, because it's natural leverage, right? People pay for this. We are on the other side. Second block would be equity dilution, like hyperliquid airdrops. It's working, right? This is all working, right? Credit markets are working, like loans against Bitcoin, massive size. It's all natural yield. Some early stage protocol tests sometimes not working. That's all right. Second block, when people look at my positions on like Curve, Uni, right, or hyperliquid, like guys, you're losing so much money, like you're losing like tens of millions of dollars. Of course, we have a hedge on Binance that they don't know about, right? So of course we're making money. We clearly like on chain, we have negative gamma, right? That's hedged through options or somehow else. So people don't know what we're really doing because it's a black box. But that's why when you look at Uniswap pools, they are all losing money on chain. But there is a second leg, right? That we are bound, right? That we're making money, right? And that's a big difference, right? In terms of what we do. The third block about things like, for example, you mentioned Plasma chain, right? So we run the largest vote with Midas on Plasma, right? And I'll say net assets that came in. So I think we put almost $1 billion, right, ourselves. And it was levered, right? It's what levered credit votes. It's a normal TradFi leveraged credit. In TradFi, credit is usually 4x levered, right? So you borrow it like LIBOR plus 200. We do the same with Maple Walls, right? We put 200 million. Robert, how much you believe? Like 3x leverage, right? So like here you go, like $600 million coming to Plasma. It's all working because they're subsidizing the borrow rate. It's building the chain. It's natural, right? And then you have more users coming. So it's a normal process. Of course, they have outflows. They stop the campaign, but half of it's still there, and it's took off, right? So I'm just giving you a perspective that not everything that happens, what we do, is complete bullshit, right? Half of it is probably fake, but there is real traction, some of them, which is actually moving forward. Right?
No, you're absolutely right. You have to. You can't get a consistent user base if the user base is trapped without liquidity. That's where Turtle comes in, and they provide the liquidity. If you've got a new project, you go to Turtle and say, hey, by the way, I'm going to give you a whole bunch of incentives, and please help me with the liquidity. And that way users can get in, they can get out, they can use a bridge, they can do whatever, right? And you might give away some points to do that. But at the end of the day, sitting on the other side of it, as a user, like what you're really focused on, and I don't want to be too brash here, you need to make money. You're putting capital at risk, whether you're providing liquidity, whether you're locking it in a bridge, or you're using it on a different L2 that you haven't used it on before, or an L1, whatever. You're effectively taking on risk, and you have an expected return. And so, where are you guys? Open question to everyone. Where are you guys seeing users that are demanding a real return, maybe 10% or more? On the stables that they risk, on the assets that they pool, on the tokens that they swap?
I can start, right? I think the first question is, if someone tells you we'll make 20% or more without volatility, it doesn't exist, right? So even in TradFi, more than 10% wouldn't carry risk, right? Risk-free rate is anywhere above it, right? So we'll have risk, period, right? So that's why in crypto, there are 2 blocks. One is, I would say, credit yields, basically loans against Bitcoin. You can deploy capital, at 6, 7, 8%. They would lend it out against someone else, against Bitcoin. They would lend out at 8 to guys like us, right? So there is natural yield. Call it 6, 7, roughly, maybe 5 to 8 range, right? Second block would be basis trade, which is effectively, think about it as if you have a brokerage account, it's called sweep, right? In London or the US, if you have cash sitting, you can lend it out to other traders, and they pay for you, let's say 6% a year. It's exactly the same what people do for basis trading, right? It's effectively sweep an exchange, or you do basis arbitrage like Athena, right? You clip cash and carry, right? This goes from anywhere from 5 to 15% a year. Anything above this wouldn't carry risk, like arbitrage between exchanges, like Hyperliquid, Aster, centralized exchanges. Third block would be Turtle Club, LP deals, right? So you take early stage protocol risk, you take smart contract risk, right? And you take leverage risk, right? So all this combined would push you to single double-digit yields. Anything else would be also like 20 plus would have to be effectively a form of equity deal. You have to take some directional risk, either on token or something else. All the yield farming stuff, like buy a token is making a 50% yield farming, is all bullshit, obviously, because it's a deflationary, inflationary clearly distribution of yield, right? So you're losing 10% a day and you're making 30% a year.
If you're getting a 20, sorry.
Yeah, this is a question to Vadim, or maybe actually to you, Armaan. So do you see more demand coming from for fixed yield instruments and products and yield strategies? Because I would expect that with more of a traditional audience coming on chain, but beyond maybe Pendle and what's going on there, don't really see a lot of building in that space. I'm not super focused on it either, but just keen to get your thoughts.
Absolutely. Structured carry is a theme we're seeing like across our LP base pretty consistently, right? That includes trades like ETH staking with options overlays, which I mentioned before, includes basis trades. So, Vadim's captured it pretty appropriately, I would say as well. If you're getting a greater than 20% return, the likelihood of risks that exist under the hood are relatively significant. And if it's not protocol risk at the smart contract level, it's likely that the balance sheet of the DeFi protocol itself is highly leveraged in order to get that return, right? So that's like a real risk that a lot of LPs aren't necessarily looking under the hood to find out about. But it's our responsibility.
No one looks.
Nobody looks. But it's our responsibility to do the diligence and bring them that information so that they reduce their time to deployment and they can generate a return without really worrying about the risk too much.
Yeah.
There's another block when you make more than 20, sometimes you have just a subsidy. Big chain is just subsidizing with equity. Like PayPal did it on Camino, on Solana, just put, I don't know how much you pay, like $1 million a month, right? Or a week. Few subsidies, free money, right? Take it. We did. So a second example can be Flare chain, subsidizing Spark DEX, basically Flare rewards, right? Other stuff. It's all working, right? So obviously bringing capital in. Ripple is doing the same with XRP on some like leverage positions. Plasma is doing it. It just, that they're just giving you equity to bring capital. So this is real, right? This is not fake.
And so we've been told that the liquidity is increasing because the institutions are coming. We've been told that this is a good thing, but suddenly you have compression of margin because the liquidity that comes in is smart capital. It's looking for safety. It's not taking any exogenous risk. Where do you guys see that the cross section between where, if institutions do come in, what are they looking for, and how do we appropriately service the market given we really haven't introduced any new users over the last maybe 3 years, maybe 2 years?
I think maybe if I can start, a key role that I see institutions playing and a lot of the conversations and the engagements that we have on with financial services institutions is as asset issuers. So bringing assets on chain, real world assets, and therefore also exogenous yield bringing on chain, right?
Yep.
So I think there's a very key role also to attract more liquidity.
Yep.
Bring all those assets on chain. Obviously, they look to deploy that across multiple chains, which is why we're talking to them, and still have like one global supply that they can manage and operate to remain flexible. But I think that's an important role that the institutions are playing, and they're definitely coming. Big asset managers, banks, tokenized deposits, stable coins, they're all coming.
But we have to redesign, right? Like when NVIDIA swaps for 1 inch, like you you can't just sell it to anyone. You need a KYC flow. You need to be an institutional investor in some parts. Like, we are redesigning that. Are we not redesigning that? Where does that start and stop with you?
I think there's different approaches, but if you look at the progress that the likes of Ondo Global Markets have already made, the
Sure.
things that Centrifuge is doing, super interesting with their tokenized funds, and then have a decentralized version of that. So they're all pushing the envelope to broaden access for these instruments. So we've not seen the last of that, but it's definitely developing pretty rapidly.
I think they're also looking to park their capital in protocols that have three things, right? They have protocols that have sort of a diverse LP base. They have repeat deposit behavior across market regimes, right? And then also they're looking for protocols that at least have a path to fee-based revenue, where once incentives taper off, they can still call this a permanent home for their capital. I think that's important as more institutions come on chain and look for permanent homes for capital. Yeah.
Yeah, I would say it's already possible. You can buy NVIDIA stock by buying Ondo RWAs.
Yep.
You can even
You can even buy Bitrace.
choose any asset what you have, even your meme coin on OneInch or other aggregators who supports Ondo. So we were one of them. We have compliant market makers who settle your trades. So you can sell any meme coin against Apple stock or NVIDIA stock. It's already there. So I'm very wondering every time when people say, "Oh, next year we do a lot of RWA and it's going to be tradable on DeFi." It's already there. It's already working. There's already volume, good volume. So yeah.
It'll be the 10th time that gold has come on chain and no one is interested. It's so in 2022, we all became economics experts. Everyone started caring about interest rates for the first time ever in their lives. And now we're in a very, very similar position where everyone is looking at the Fed. I think we've got a rate decision tonight, right? Tomorrow. And so everyone is looking at that liquidity profile. We are expecting the Trump administration to pump liquidity into this market, and our altcoin bags are going to go up. Well, what's the general consensus view from people building, people investing, taking people's money to put it into protocols? Like, open question, are the people right? Are we going to have a liquidity influx?
I can start. I'm not an economist, of course, so take what I say with a...
What do you mean? We're all economists.
Sure. If you insist. So take whatever I say with a grain of salt, I guess. I suppose if you believe the tightening cycle is now behind us because inflation's been dealt with, then there'll be a massive influx of liquidity in the following sort of financial year, right? And maybe that's also being evidenced by certain factors. If you look at the reserve repo balance, if you look at the TGA building up over time, and a number of other macro factors as well. So if you think the tightening cycle is behind us and inflation has been beaten, then your guess about there being a massive liquidity wave in 2026 is right, and that's going to be a supportive tailwind for risk assets. Yeah.
On my side, I think it's very simple. You should look at a few cycles, right? So first of all, U.S. equities are doing really well, right? So earnings in the U.S. extremely high. Like 20% growth year, right? So they're beating everything possible. So the valuations of the U.S. equity market, which is at historical highs, is generally justifiable, almost fully justifiable based on the majority of the investment banks. So people call it rational exuberance, right? In crypto, right, so it's slightly different because Bitcoin is not at the all-time highs as U.S. equities, right? So we clearly see a lot of sell-off on altcoins, a lot of liquidity coming out, right, and so on. So that's why predicting what's going to happen, extremely hard to say, right? There was a lot of pump from the U.S. administration by issuing their own tokens and so on. Look, again, it's a venture business, right? So 9 out of 10 of those tokens will not exist. So there is a wave coming in and out. So where's going to be? I mean, honestly, we have no clue. That's why we run a market neutral fund. So.
Yeah, no, understood. We were speaking in the back about making money, but you've got a great story about losing some money in the FBI.
Yep.
Do you want to share that with the audience?
Sure, yeah. I can give you a couple of comments on this, right? So the core risks for people, especially in our business, have been always hacks, right? Hacks of smart contracts, hacks of your wallets. I think pretty much everyone knows someone who lost money because of a hack, right? So this number of hacks has been reducing over time, right? So I was telling the people, when we started the business, it was 5 years ago, we had a crazy story, right? So I was in Miami meeting Mayo Suarez, right? He's very pro crypto like audience event, and I'll change the names a little bit, right? I was sitting next to a girl, and I'm like, "What's your name?" She's like, "Well, my name is Amanda." I'm like, "What do you do?" And she was FBI special agent, right? Doing it for 10 years. I'm like, "Holy shit!" You know,
How nervous did you get? Was that you're like, "Please
well, I
get
wasn't.
me out of
I'm
here."
like, I hope I won't see you again, right? So guess what? 2 months later, we got hacked. One of the companies that we invested got hacked. We lost $1 million. I'm like, "Hey, Amanda, my name is Vadim, right? We met 2 months ago. We just lost $1 million. We have US clients, obviously, right? Can you help us out recover the assets?" And she's like, "Vadim, I'm so sorry, lost $1 million. It's too small for us to handle. Good luck." I'm like, I was so pissed. So we started tracing the assets on chain, where they went, and we found a nickname, right, in one of the wallets on Etherscan. And it was called MEV King 1, right? So, and we found the same guy on Twitter. We're like, this is the guy, right? So, and he's talking about this manipulation algo strategies on lending smart contracts, right? So next day, I have FBI agents in my office in Boca Raton doing screenshots. We went undercover, started talking to the guy, right? Basically directly. And he's in hiding, right? So then we found his accounts going to Coinbase in the US. So we subpoenaed the accounts. We found his real name, driver's license, address in New York. So he's American, lives in Puerto Rico. We're getting the guy, right? So we started talking to him for a few months, right, through Twitter. FBI is doing screenshots. We tried to hack Polygon, but don't tell Sandeep, so otherwise he'll be upset. We clearly didn't, but we're like, why don't we meet? Because we need to physically meet with the guy to confirm his identity. So I was about to fly to Puerto Rico. That's where he lived. And we're having a call, FBI, CIA, AUSA, SEC, AUSA. And like, we're even going to fly down there. It's going to be a controlled environment. You'll be in a wire on the mic.
Very
right?
James Bond of you.
I'm like, and they're like, don't worry, it's going to be a SWAT team around, right? So like, all going to be safe, right? I'm like, he's a nerd. What he's going to do to me, right? It's like 25-year-old kid. And the day before the flight, so she calls me and she's like, SEC pulled out. I'm like, why did? And they're like, these are not securities, right? That's why they don't want to make it a public key. So I'm like, shit, right? So they screwed us basically. But we got paid by insurance later. It's all good. 6 months later, the same guy hacks Mango protocol on Solana for 150 million, right? Now he's in jail for 25 years.
Insane.
But this is experiences like this happened like 5 years ago. Now it's like more calm, more structured, more clear. Everything is getting more audited, right? Less hacks taking place. But anyways.
Balancer recently.
Yes.
It was 2 years in production and got hacked.
Look, that's why I was telling everyone, that's why we buy insurance. We're the largest insurance person in the world against hacks through Nexus, and we structured first ever TradFi insurance. There's no solution, right? It's unfortunate that that's part of the hack period.
Actually,
right?
less are doing this, the insurance. So I think Aave, the traditional insurances.
We actually signed first ever TradFi. It's 5 insurance companies out of London. We signed the deal, cost me like about $2 million, right? But it was worth it.
Yeah, Aave start doing that. What I understood with the new app, they bought additional insurance with the Aave app, so you can just.
They have to, because it's a retail product.
Yeah, but it sounds nice, like 1 million per account. I'm not sure that they can cover it, but that sounds nice. Better than in Germany in the bank, I would say.
True. Yeah. So cost of insurance for Aave ranges right now from like 3 to 5% a year, roughly. They have 300 million in the safety model, exactly. Yeah. So that's sufficient if you limit it million each, right? Think about it. Aave has multiple chains, right? Slightly different codes. RBV1 was hacked a year and a half ago, for $10 million, right? The older version. But
I heard, yeah.
Question like how much can you lose, right? So if you lose like everything, look, it's a complete disaster, right? But usually we would assume if it's a hack, they will lose like 3 to 10% of assets, right?
Yeah,
on one chain.
I'm not sure. It's a pool-based money market, so if you understand
that's what I'm saying. You split it by chain, right?
It's get hacked. Like Euler, for example, also money market got hacked because they didn't follow these industry standards in terms of security and got hacked. And everyone lost everything, right? Until this guy returned, right?
Cream Finance.
Cream Finance, yeah, that was. Yeah.
So look, it's risk, period, right? It's like hurricane insurance.
Yeah, insane. So, guys, I really appreciate the time. I know we've got 5 minutes left. Any final closing thoughts? Anything that we haven't covered from a liquidity user perspective, from making money on chain? Any alpha you've got for us? No, good. I see Turtle's very quiet in the back there. This is your job. This is making money is your forte.
We're doubling down on distribution. We're doubling down on curation and risk. And we're effectively doubling down on creating a full stack around the liquidity provision process.
Okay.
Due diligence, partner dashboards with richer insights, the ability to track those campaigns. That's where I suppose we're headed. We're going from a liquidity campaign launcher to like a liquidity operating system. That's how we think about the next 5, 7, 10 years.
Fantastic. Okay.
I think on our side, maybe a couple of comments, right? What these guys do is great, right? Obviously, like multiple pools, they bring new companies and protocols in. They did a great deal with Etherfire, right? So like, look, this they're like what 8 billion now, right? In dollar terms, right? Success, right? So don't get me wrong, it worked out, right? You did a number of other deals, right? That some of them worked, some of them didn't. That's all right. The ones who worked out did successfully well, right? So on our side, it's the same. We see a lot of inflows slowly coming in. The markets are getting more regulated, more controlled. People bring fund administrators, external verifiers to bring confidence to the market. So definitely the market is getting more mature. Credit business has tripled over the past 18 months, right? So Avi went from 30 billion to whatever, like 70 now. If you add total credit, it's about more than 100 billion. So this is sizable amounts, right? Now you have tokenized assets coming. All these RWA assets will be levered on chain, right? So if like Pluma's doing it, Avi's doing it, Plasma is trying to do this, right? So this is all happening, right? So it's a global distribution of liquidity. Because look, if you live in Dubai, even buying US stocks is a pain in the neck, right? So you buy it, you have to go through users funds, not to pay US taxes. Why? Right? Buy it on chain. Very straightforward.
Yeah.
If you want to buy credit fund in the US, you have to be a credit investor. You must come to the feeder, right? Then you pay Goldman Sachs 1% upfront fee. Why? Just buy tokenized version of it. That's it. So.
It's exactly what we at Infinex. Our entire mission is to bring users on chain, right? We have spent all of this time building this amazing core infrastructure and creating all of these artificial hurdles that people need to jump through in order to welcome into our ecosystem. But we can't, because you first need a private key and a public key and a wallet, and then you can't, because then you need gas. So if we abstract away from all of that, if we make it really easy for the user to be able to become on-chain, then we can just point it to protocols that are doing the infrastructure bit. You just point it in the right direction, and they get a great, safe execution. They get finite liquidity that is available for any asset on any chain, and that's the core principle. Like we have 188 million KYC accounts trapped on Binance. We need to get those people on chain. That will improve the liquidity. That will improve the overall structure of our ecosystem. So, guys, thank you so much. Really appreciate it.
Thank you.
Thank you.